Welcome to the show. Today we're talking about ESG investing, and we'll come to exactly what that is in a second. My guest today is Beth Brearly, who is news editor of Investment Week. Beth, welcome to the show.
Hello, hi.
Thanks for joining us. Perhaps if you could just start by telling us a little bit about yourself and what you do.
Sure, I'm a financial journalist. I have been for 12 years, specialising in personal finance. Currently news editor at Investment Week, as you say, and that is a business title aimed at wealth managers and fund selectors.
Okay, super. So ESG, what is it in a nutshell?
So ESG is an acronym. It stands for Environmental, Social, Governance. And what that is a set of standards that investors look for before investing in a company.
Okay, so when you're taking those standards into consideration, how does making an ESG investment differ from any other kind of investing?
Well, the lines between what you might call regular or traditional investing and ESG investing are becoming more blurred. Whereas 10 years ago, it was considered perhaps a niche area of investment. Nowadays, it's becoming more core to investors' portfolios.
Okay, and does it mean more risk though, if you're investing in something that's just kind of being judged by those criteria? Is it more risky than standard investing?
Well, one of the main points about ESG investing is that it's seen now as a risk management exercise. So by approaching those three standards, companies are looking at lowering their risk, so they're not liable to any shocks or scandals like the BP oil spill would be a good example. Perhaps some of the difficulties rather than risks of ESG investing would be looking at companies and finding out more about how their ESG standards fit in. So the onus is on them now to make that information available, and in fact the London Stock Exchange has called for companies to be more transparent in where they stand on ESG and to publish information on that alongside their annual results. Presumably
this isn't, it is relatively new, but presumably it's a developing marketplace. How has it changed over recent years?
Well, there's been a proliferation of new products in terms of funds, which are a collection of companies managed by a fund manager. And fund groups are also realising how important it is to have their own ESG strategy in place and have been hiring lots of ESG heads to manage those strategies.
And do you think ESG markets offer increased longevity as people become more ethically aware?
Yes, I think by their nature, companies that are focused on ESG, as I say, as a risk management exercise, are likely to be around for longer. And I think you have to bear in mind that companies which are involved in the destruction of the planet aren't likely to be around for very long.
Okay, and so I suppose one of the elephants in the room, if you like, with ESG investing is around profitability. Am I going to get the same return as I would from standard or normal investing? Is that true?
I think that's a misconception. So recent research by MSCI found that within emerging markets, companies which are more on top of their ESG requirements were outperforming by 14%, and the companies in developed markets were outperforming by 5%, which is obviously a notable outperformance.
So to sum all of that up, imagine I was making my first ESG investment. What would your top tips be for somebody starting down that route?
So first of all, as with any investment, investors need to decide what their end goal is and what their time frame for investing is. They need to look at whether they want to invest in companies directly or whether they want to use a fund, which, as I say, is a collection of companies, and then see how their values align with companies' values, whether they want to avoid companies that don't rate highly in terms of ESG, such as armaments companies or gambling companies, or whether they want to have low exposure to such companies, or instead whether they want to actively engage with the companies by investing and becoming a shareholder and helping them improve their ESG credentials. Other investors might use what we call negative screening, where they don't avoid the companies completely, but they might limit their exposure to those companies.
Right.
Lastly, I'd say investors then need to monitor those investments to make sure companies are doing what they say they will. That they're not just greenwashing, pretending to be more environmentally focused than perhaps they are, and the same with funds, that they're doing what they say they will.
Beth, that's been fascinating. Thank you very much for taking the time. I've certainly learned a great deal. Well, that's all we have time for today. Please keep your ideas coming with comments and suggestions for future shows. Just leave them in the comments box underneath this video and we'll try and cover them in future episodes. Thanks again for watching. See you next time.